Let's get to the big discussion this evening on the India development debate. The banking contagion may be for real, but India will be able to withstand the turbulence, it seems. In fact, business tycoons like Uday Kotak are confident of India standing strong amidst the global financial storm. But are we really safe? Well, for now, we're seeing some semblance resuming, at least with the Credit Suisse stock that gained as much as 20% in trade today after Swiss regulators pledged a liquidity lifeline to Credit Suisse in an unprecedented move by the Swiss National Bank. That's their central bank. The steep drop in Credit Suisse shares had unnerved investors already on edge after the collapse of US-based banks Silicon Valley Bank and Signature Bank. And now there are reports of First Republic Bank, that's another regional bank in the United States, being in trouble. But look at the situation in India, in the Indian banking sector, where we continue to be robust. It's important to look at this even as reports come of some amount of exposure that Credit Suisse has in India. It might impact us more than Silicon Valley Bank. To assess the situation as it stands, I'm joined now by Mythili Bhusnurmath, consulting editor, ET Now, Ajay Bagga, chairman of Elements platform and market expert, with me on the show. I'm also joined by Geoff Dennis, independent markets expert and commentator, Siddhartha Sanyal, chief economist and head research, Bandhan Bank, also with us on the show today. Welcome to all of you, and thank you so much for speaking with us. Mythili, I'll open with you. And you know what we're seeing happening with Credit Suisse 48 hours ago, and I know Credit Suisse has been in trouble for a while. There's murmurs here and there, but 48 hours ago, this kind of panic where, you know, their central bank has to throw them a lifeline. There is one report says that UBS might come and take over. All of that was unimaginable for a name like Credit Suisse. What is your assessment of what's going on in global banking?
Well, the reality is that confidence is very, very important in the banking sector. And it just goes to show why regulation and even more importantly, supervision is really critical for banks because there is a real risk of contagion and the entire economy capsizing. Because essentially, gains for banks are privatized while the losses are invariably socialized, which is why you see authorities one after the other coming to rush to the rescue of banks. We saw in 2008 crisis when the US decided not to bail out Lehman. And we saw how the entire world, it took us almost 2, 3 years to get out of that situation. So clearly, one needs to have very good regulation and even more importantly, supervision. As you mentioned, Credit Suisse was in trouble for a long time. It's been, a host of scandals over a period of time. It has been penalized again and again. It was one of the 30 largest systemically important banks identified by BIS. So clearly, there was something lacking as far as supervision is concerned. It's not only Credit Suisse, Citi, Wells Fargo, all these banks have done various, indulged in various activities which regulators have frowned upon. Penalties have been levied. But despite that, I think supervision in the US has not been up to the mark. And that is why we're seeing what is happening in the case of Credit Suisse. Hopefully, the contagion will be contained because supervisors, I think, have learned a lesson. Authorities have learned a lesson, and we must hope that it will be contained because even though Indian banks don't have a direct exposure, if the world economy capsizes, so will we. That's what happened in 2008, and hopefully will not happen this time.
Ajay Bagga, I want to understand what really is the issue with Credit Suisse. I mean, we spoke about this briefly when they talked about some material problems in the way that they were reporting financially. But this seems to have gone way beyond it. What is the issue, and why was their central bank looking so hesitant to offer a lifeline? It finally has. There's political pressure also in Switzerland saying, why are you guaranteeing a bank's investment or investments in an investment bank rather than depositors? How do you see all of this playing out?
Yeah, Tamanna, building on what Mythili very rightly pointed out, if you look at Credit Suisse, it's not the bank it used to be. 2007, it was a $1.2 trillion bank. Today, it is 560 billion. As recent as the December quarter, it lost about 100 billion euros of wealth management deposits when customers fled. So it has been multiple years in happening. Risk management controls have been poor. There have been something like 7 restructurings announced since 2007. And be it money laundering issues in Eastern Europe, be it the hedge fund blow-ups, be it Grenfell, be it selling wrong products to customers, and now the latest where the last 2 years annual reports are being restated, where they are saying they don't have confidence in their own financials. It has been a long journey of not being able to get out of the trouble the bank was in. It hurt a lot of other European banks, similar issues, and American banks, but they have been able to sort out most of the issues. Credit Suisse, what is hurting it right now is a statement by its largest shareholder, the Saudi National Bank, who were asked that in case there is trouble at Credit Suisse, would you be bringing in more capital? Now, remember, this bank is down to 7 billion euros of market cap, and a few months back, they had raised 4 billion euros in equities, which are, gone down to nearly 30%. Now, this Saudi National Bank had a regulatory limit of not being able to go above 10%. But instead of saying a roundabout answer, they gave a very direct answer saying absolutely not. And those two words led to the meltdown
So,
yesterday.
Bagga, I
Uh,
saw that full quote, and the person quoted goes on to say that we cannot do it because we're not. It's against the regulatory limits.
yes.
So they did not infer that there's something wrong with the bank. That's why we don't want to put more money. They said we're already at 9.9. We're not allowed to go past 10. Are you
But,
saying that so
yeah.
much of nuance is being read into by the markets?
It was right because the largest shareholder, another large shareholder, had just exited fully about a month back. A long lasting large shareholder had sold off completely a month back. On top of that, the largest 9.9 shareholder saying this was taken very negatively. And if you see their statement today, Tamanna, they're saying all the right noises they are making. It's a 150-year plus venerable institution. There is no liquidity issue. All those things are coming in. So you have to be very careful when you are making a public statement like this. It can be exaggerated out of context. But would it have happened to another bank? Doubtful. It was the situation in which Credit Suisse already was, and that led to this. The good thing is the Swiss National Bank and the FINMA, the financial supervisor, moved very fast. And at 2 a.m. This morning, they announced a 50 billion Swiss franc line, a $54 billion line for them. Again, today, if you see Christine Lagarde at the ECB press conference was asked very particularly on European banking and solvency liquidity. And she was at pains to say that we have seen and we are differentiating between inflation and financial stability. We have the tools for financial stability, and our banks are much stronger than 2008. And we don't see a solvency issue of 2008 striking the main European banks. We are confident. So that was a vote of confidence. Today, Credit Suisse opened 40% up, then it went down to about 17% up. But overall, the Swiss National Bank, the ECB, and even the Swiss government held a meeting today. There are three, four alternatives in front of Credit Suisse. One is to split it up. There is a Swiss bank, so it is the Swiss Bank of it's the State Bank of Switzerland in a way, along with UBS and Julius Baer. So that itself would be a 14 billion market cap bank on a standalone basis.
Right.
So you could have a demerger. Investment bank will probably be shut down because of the risk issues. I don't think that will survive, and that has a negative worth of about 11 billion euros.
Wow.
And then you have the wealth management business, which could be merged with UBS. That could be one golden way of looking at it. Both would, you know, benefit from that. So UBS merger is a possibility. The Swiss government taking equity, bringing in more equity is a possibility. The Swiss National Bank converting its loan into equity is another possibility. So a lot of possibilities. This bank is not failing. It is not 2008. That is very clear.
Okay, so I don't know how reassuring that is, because yes, it's not 2008. That's good news, but it's also exposing large gaping holes in a very reputed bank. And Geoff Dennis, is that really the takeaway that's worrisome? That Credit Suisse will be saved, like Mr. Bagga explained all of the options, but what is it telling us about the state of global banking and investment banking?
Well, I think I agree with Ajay. I think the bank will be saved, and I think that's the main takeaway from this. Excuse me. And I think the important point here is that the crisis at Credit Suisse is completely different from the crisis at US regional banks, which was basically due to investments in bonds that have gone down, funded by short-term deposits, essentially. Whereas Credit Suisse, as Ajay said very, very clearly, and your previous speakers said, is has had a run of problems, which this material misreporting of the last 2 years of results is the latest. And I would actually make the point that if it wasn't, however, for the regional bank crisis, you would actually not have CS, Credit Suisse, in quite such a crisis today. In other words, they've melded together, even though in my opinion, they are completely different stories. And so as far as I'm concerned, I'm sure there are many solutions to to the crisis in Credit Suisse, and your previous speakers have outlined those, and I do not believe it will be allowed to go to the wall, and obviously the injection from the SNB is very, very important. But I do think we have to keep these two things completely separate. CS has been in trouble for a long time, whereas obviously the sharp rise in US interest rates, 450 basis points at the short end and something like 350 basis points at the long end, to the recent high of US bond yields, is what's really caused a problem for a badly mismanaged bank, which was Silicon Valley Bank. And it's that, not the Credit Suisse issue, that is putting the pressure on some of these other regional banks, even though there's no suggestion that, for example, First Republic or any of these other banks were actually doing the same thing as SVB. So you have to keep the two separate. But I think the S&B's done a great job by agreeing to lend this money to CS in the short term.
They seemed hesitant, Geoff Dennis. It wasn't as if they jumped to the rescue. And I think that's something that investors saw very clearly. They seemed hesitant. One of their key political parties are saying, why are you backing, or, why are you giving this kind of a sovereign guarantee to Credit Suisse? So it's not all easy, an easy glide there.
Well, I think the issue here is there's always moral hazard. There's always moral hazard. And if you're seen to make a mistake as a bank and you quickly get, bailed out, I think that creates potential problems down the road. And this is the dilemma you face when you're in a 2008 situation, or indeed this type of situation. But the bottom line is ultimately, the US Federal Reserve has come to the rescue, so to speak, of SVB by saying, or at least the US authorities have, by saying all depositors will be made whole. S&B's come ultimately to the rescue of CSS, Credit Suisse, with this big loan. So I think ultimately the backing is there, but I think there's always a moral hazard issue, and this is why it's a very, very fine line to draw. But at the end of the day, I'm very firmly of the opinion that banks' capital ratios worldwide, particularly perhaps in the developed world, which was where the 2008 crisis came from, are much stronger than they were 15 years ago. And I do not think this is going to turn into a major global banking crisis with lots of banks going bust. And this is why I think once the world settles down here, you're going to have some nice buying opportunities in equity markets around the world.
Okay, so then that's great. That's at least some reassuring news. Mr. Sanyal, I wanted your take on the India impact. There's a report today saying that Credit Suisse has assets of about 20,000 crore rupees in India. We also played out Uday Kotak's statement a short while ago about how the robustness of the Indian banking system really stands out right now. What do you think will be the extent of Indian impact as far as CS is concerned? And is this really also highlighting our systems here?
Well, if you see the overall size of business and assets and exposure of various Indian entities vis-a-vis Credit Suisse, it's possibly for some of the entities, it may not be absolutely an amount that you can ignore and wish away. But at the same time, for a system as a whole, it's pretty manageable and pretty small. So we don't see any possibility of any systemic risk because of this particular incident, though in today's world you cannot be complacent, but there is not too much of a room or not too much of an immediate fear of any system level risk. If you see in terms of regulation of Indian banks, typically you see that they are some of the regulatory prescription levels are stronger or stricter than compared to many global economies or larger economies and other EMs. And more often than not, most Indian banks end up keeping a buffer over and above the regulatory minimal levels. So my sense is that you do not really see any kind of a situation anytime soon that can throw significant reasons to worry about any systemic risk anytime soon.
You know, as a contrast, Mr. Bagga, I want to get your take on this. Indian banking, is it coming out looking much better at this point? And, you know, your take on the 20,000 crore figure that's being headlined today of Credit Suisse exposure here.
On the Credit Suisse exposure, Tamanna, we have to see on balance sheet and off balance sheet. This is on balance sheet. A lot of derivative exposures are there, offshore lines are there, and that is estimated at 7 times. But that will be part of the India country risk. I'll give you a small example. Suppose my wealth management customer wants to leverage his money abroad. He could bring a standby letter of credit from Credit Suisse sitting in Zurich and take a loan here. That will be part of the India country risk that Credit Suisse has taken. And if the customer defaults here, I have to go back to Credit Suisse Zurich to make good my NPA. So those kind of loans might be there to some extent, but again, those are within the RBI's framework. If you look back 2008 to what happened with the Lehman balance sheet here, it was ring fenced. The money was not allowed to be sent abroad, and the money was used to settle all the claims and liabilities within India. So the RBI moved very fast on that. Normally, you have to see, coming to the Indian banking structure itself, you have to look at the architecture, you have to look at the operational framework, and then the supervisory robustness. I think on all three, RBI has been quite strict over the last 15 odd years. We have worked out a huge set of NPAs, nearly 16 lakh crores being written off is no joke. So it was one of the most ailing banking sector in the world because of bad credit decisions. And now today it is a much cleaned up segment of the economy. Comparing to the risks that are coming out from the US banks or a few of the European banks, our banks are not leveraged to that extent. You have very strict credit, CRRs, SLRs. Then in terms of the LCRs that the banks have to maintain, the stress tests that are carried out,
right.
The risk is on the cooperative banks, which we keep seeing, but those are very small and RBI is cleaning them. On the scheduled commercial banks,
Right.
the risk is very little now.
Okay, Mythili, quick word from you because I've actually quite run out of time, but I wanted to get your take on this specific issue of how India stands in terms of a banking system. Ajay Bagga has talked about the journey we've made from very high NPA levels to today. Should we be hoping for some kind of a statement or signal from the RBI in the middle of all of this?
Well, the RBI might just come out and say that the banking system is very sound, which it is, but it's not that we haven't had our share of failures. We've seen Yes Bank, ILFS, Diwan Housing. So we have seen cases where, well, RBI did fall short as far as supervision is concerned, but the nature of our banking is very different. Unlike banks abroad, we don't have these kind of wholesale deposits. the deposit base of banks in India is retail deposits, a large number of retail deposits. Nor are they so focused on any one particular sector, as we saw in the case of Silicon Valley or in the case of Signature. So I think that makes a difference. And also, investment banking and commercial banking are kept quite distinct. So to that extent, I think our banks are certainly safer. But we have to remain that you have to eternally be vigilant, because even though you have Basel norms and higher capital adequacy norms, etc., I just want to quote what Walter Bagga said. What he said: he said, a well-run bank doesn't require any capital at all, and a badly run bank, no amount of capital is sufficient for it. So confidence and well-run banks, well-supervised banks is the only answer. That's the only way going forward, both in India as well as abroad.
That's an interesting sort of context setting as well. We have had our share of problems. It's not that we haven't, but the regulator has stepped in pretty quick. And of course, maybe the global impact is not as large. A Credit Suisse in trouble is definitely a global story at a different level. Thank you so much to all of you for joining us. We'll take a very short break, but on the other side, our in-depth coverage of the big change of guard at TCS. Stay tuned for that.